Hello, good morning. I think we're on, so thank you very much everyone for attending our presentation of our annual results for the year 31st March 2012. I think the format is that I will go through, this is Ben Habib here, incidentally, Chief Executive of First Property Group. I'll go through our presentation, which is on the website already, if anyone should care to follow it as I go through it. And then we'll open it up to questions from the room as well as on the telephone. I have with me in attendance as well from First Property Group George Digby, who's our Finance Director, who will be able to take the more financially orientated questions, and Jeremy Barkas, our Marketing Director, who's responsible, amongst other things, for fundraising, if you should have any questions about that in particular. So just starting at the beginning, very briefly, First Property Group is an AIM-listed property fund manager. We deal only in commercial property, that's offices, shops and industrial, with a smattering of leisure. We've been going since 2002 in our fund management activities. We manage 6 funds at the moment, predominantly based in Poland. 70% of our assets are in Poland, 27% in the UK. Our business model is to raise funds from third parties, earn fees from the management of those funds, but also to invest in those funds ourselves. So we have direct earnings, as it were, from property as well as fee income. So turning straight over to page 4 and the results themselves, we've had a very good year for the year to 31st March 2012. Pre-tax profits were up from 2.95 million to 3.97 million. The main reason for this was the effect of the full year of earnings that we gained from a fund that we launched in October 2010, Fprop Opportunities plc. Fprop Opportunities plc bought 2 properties in the latter half of 2010, but we've had the benefit of the full year's worth of earnings of those 2 properties in the current year, and it contributed about 1 million of pre-tax profit. We own 84% of Fprop Opportunities plc, and it contributed about 1 million of profit to the group. Because of the increase in our pre-tax profits, our earnings per share similarly up, as it happens, by 44%, because we had a slightly lower tax charge this year, which we can go back to later on if there are any questions on it. But we had a slightly lower tax charge, so EPS was higher, with a higher rate of growth than our pre-tax profit. And on the back of these good results, we've increased the dividend by 2%. Profits by segment are broken down: 2.74 last year for fund management, up to 3.07 million this year, which is a 12% increase. And then profits made from our co-investments in our funds, as well as properties we own directly, was up very substantially, as I mentioned, as a result of a full year's worth of earnings from Fprop Opportunities plc's investments. Our net assets are up by 5%. And perhaps, interestingly for shareholders, our cash position is up quite significantly from last year, and we've now got about £10 million worth of free cash in our balance sheet. Assets under management are up from stable, in fact down 1 million. For most of the year, assets under management were up. And the reason they were very, very marginally down at the year end was as a result of the euro weakening. During the course of the year, the euro was at about 1.16 against sterling on average, and at the end of the year it was 1.2. And as a result of that slight weakening at the year end, it appears that assets under management have dropped slightly. The mixture of assets under management has changed quite a lot, as evidenced by the percentages below the asset management figure. You'll see that last year we had, this is for the year 31st March 2011, we had 75% of our assets in Poland. Now we have 70%. We haven't actually made any sales of assets in Poland. The reduction in proportion is a function of our buying more properties in the UK as well as the euro weakening. So our assets under management in the UK have moved from 22% of our total assets under management to 27%, and our Romanian investments are stable at 3%. The next page charts our dividend history, and I think, if I may be proud for a moment, we've gone through, this is now the 5th year of the credit crunch, and we, First Property Group, have gone through the entire period of the credit crunch being profitable, paying a dividend, not having to do any capital raisings, and our dividend has actually grown throughout that period. So we're very proud of that. We're also equally proud of the fact that none of the funds we manage are in the red, having now gone through 5 years worth, in the 5th year of the credit crunch, none of our funds under management are in the red. So all our clients have also made money, and some of the cash returns coming off our funds are quite phenomenal. I'll come back to that later. Page 6 gives an earnings breakdown between fund management, which is the orange or yellow columns on the left. They look orange to me. They might look yellow to you. On the right, we've got purple columns, and they represent the earnings from our group properties, which include Fprop, that's Fprop Opportunities PLC, and you'll see a marked increase for 2012 because of the full year benefit of those properties I've already mentioned. So FPAM, our fund management vehicle, pretty stable, profits up slightly, 12%, but the real driver of profits coming through from Fprop for the year in consideration. The other fact of which we're very proud, which I haven't mentioned so far, is that we have been rated again, or funds under management have been rated again this year for the year to 31st December 2011, have been rated the best performing funds under management in Central and Eastern Europe by Investment Property Data Bank, which is an independent, recognized and leading assessor, as it were, of the performance of funds across the globe. So we're very pleased with that. Our funds have therefore not only performed in an absolute sense, but from a relative perspective, we have topped the table again. And the shareholders might recall we topped the table for the 3 years to 31st December 08, for the 4 years to December 09, for the 5 years to December 2010, and now for the 6 years to December 2011. Again, I doubt there are many fund managers or property companies that can boast that kind of performance. Page 8 gives a breakdown of the various funds we manage. Our largest fund is the USS fund with £233 million under management. That fund expires in August 2015. Naturally, we have, as a group, some exposure to the expiry of that fund, and the challenge, as it were, for the management team at First Property Group is to ensure that come August 2015 the group remains a manager of significant funds, and we have every confidence that we will be. We already have made significant inroads into balancing, as it were, our exposure to USS by the launch of our UK PPP fund, which now has about 100 million, in fact, under management. We have significant interest for a new UK fund, as well as for investments in Fprop Opportunities PLC, and I'll come back to both of those in due course. But we're very confident that by 2015 the group will remain a significant manager of funds and in the good condition that it currently is. Page 9 restates to some extent page 8, so I'm not going to go through that. Page 10 illustrates what I've already touched on, which is that all our funds are in the black. The purple column of the funds under management represents the IRR or implied IRR for those funds that are still running that we would earn if we wound those funds up and sold properties at the value that they've been ascribed by independent valuers at 31st March 2012. The orange column, which is one that's really worth focusing on, is the actual return on equity those funds are currently generating. And these are cash returns pretty much. And they're very, very high. And it's a function of the sustained high levels of income within our portfolio. On a like-for-like basis, it may interest you to know that our properties are earning more now in 2012 than they were earning at the peak of the boom in 2007. So earnings in our portfolio, rental income in our portfolio has been very robust, and that has really effectively been the secret of our success. So the orange column is a function of that high sustainable income stream. And the red column takes into account total returns from inception. The other reason for our success is exemplified on page 11. The chart on page 11 shows how property yields in the UK market moved from the year 2000 to 31st March 2012. So when yields were high, property values were low, and when yields were low, property values were high. And as you'll be able to see, the blue diamonds that represent our purchases were made effectively well before the peak of the boom. We were then big sellers into the boom, and we were well out of the UK market during the worst phase of the credit crunch, when property values in the UK dropped by about 50% in total. And then we became buyers again after the collapse of the market in after March 2009. And I'll just remind shareholders that in 2005 we did predict that the UK market was toppy in the annual report for the year to 31st March 2005. And for what it's worth, we feel again that London is toppy. We don't think that the UK by and large is toppy, but the rush, I'm digressing slightly, but the rush towards core assets in the UK and indeed other major European cities has, in our view, pushed prices to unsustainable levels. What we can't predict is when that rush to core assets might shift back to a more rational approach to investment based on commercial parameters. But we do feel that the London market, as well as a number of other core European capital cities, is and are overvalued. Page 12 gives a breakdown of the exposure we have to various tenants in our client portfolios. So these are not exposures that we as a group have, but these are the exposures our client portfolios have. Procom, which is our largest exposure, is 15%. Procom/Asseco is the largest Polish stock exchange listed software designer and maintainer. Its largest client is the Polish government. It's well regarded in Poland. It's a well-capitalized business with low levels of debt and has done very well through the credit crunch. And then after that, I think the names by and large should be recognizable by you, but we don't have any significant exposures after Asseco. Asseco is our sort of largest independent exposure, as it were. The group, just turning to page 13, the group owns two properties itself. One of them is an office block in the southern part of Warsaw, which we bought for 11.7 million PLN in November 2007. So arguably at the peak of the bubble. It's valued now at 11.8 million zlotys. The earnings from it have actually gone up quite substantially while we've owned it. It's now yielding an ungeared return on equity of about 12%. forgive me, about 10%. The other property we bought was arguably at the trough of the credit crunch, which was a prime located office, well, part of an office block in a prime location in Warsaw. It's a Class B minus office block, but it was under-rented by about 25% and overcosted quite significantly. Since we bought the property, we've raised rents by about 10 or 15%, and we've cut costs dramatically in the property. So we've taken earnings in that property from about $1 million when we bought it per annum, $1 million per annum, to about $1.5 million per annum now. A massive increase in earnings coming off Blue Tower on the property itself. Then in addition to that, we bought a significant interest in the property management company that was managing that property and was and is constitutionally linked to it, and we've been able to cut costs quite dramatically in that property company. So our total earnings now coming off this investment about £1.3 million. So total rent is £1.3 million, and a total pre-tax profit contribution of about £830,000, which represents a close to 50% rate of return on equity, and that is all cash earnings. So we're very pleased with how that investment has gone. We think that office block has further growth in it, about which we're hopeful of taking advantage over the forthcoming years.
The loan on that, is that ING?
That is ING, yeah. On page 14, we've given you a breakdown of the various investments that First Property Group has in the funds that it manages. The first column is the book value of those investments. So that's the carrying value in our balance sheet. We hold our investments at the lower of cost or value. The column to the right of that is the market value, and you'll see that there's actually a marked difference between the market value and the book cost. Market value is obviously determined very significantly by what our independent values assess the value of the properties to be. We may or may not be able to sell properties at those values if we were to liquidate those funds, but the fact that there is a significant increase between our holding cost and the market value should give shareholders comfort that their capital is secure. And then the far right-hand column provides a breakdown of the actual earnings that we have benefited from for the year 31st March 2012 coming off these various investments, and that's a total of £1.3 million. I ought to just clarify that the results of Fprop Opportunities PLC, the results of Fprop are consolidated in our balance sheet because we own 84.1% of it. But the actual 84.1% of earnings coming off Fprop, i.e. earnings that we own, as it were 1.03 million pounds. Page 15 represents diagrammatically what page 14 holds, so I won't go through that. And then page 16 gives you an assessment of the various tenants to which we, First Property Group, through our investments in our various funds, as well as ourselves, have exposure to. And our biggest exposure is to Carrefour. In this case, it's Carrefour SA, the parent company in France, which guarantees the Polish subsidiaries rent and other liabilities under its lease. So we feel that even though we've got a 40% exposure to Carrefour, it's actually a very, very good covenant to which we are exposed, and we're very relaxed about it. Fundraising market is not easy. We felt towards the middle of last year, and you'll recall from our interim results that we felt towards the middle of last year that we were beginning to emerge from the credit crunch. Nothing could have been further from the truth. The credit crunch came back with a vengeance in the second half of last year. Up until the middle of last year, we had significant interest in investing in FOP. We still have interest in investing in FOP, but we haven't availed ourselves of it because we've been extremely cautious in the way that we assess properties, and we haven't felt able to identify a property, at least so far, which for whatever reason has ticked all our boxes. So we haven't taken that capital into FOP. We are now looking some semblance, I mean it's sort of meta-stable rather than stable, but some sort of semblance of stability seems to be coming back to the Eurozone, and the politicians seem to have taken on board the fact that they need to react in a more definitive and bigger fashion to the problems in the Eurozone, and that does give us a bit more comfort than perhaps we had in November/March of this year. And I think what's happened in Spain is encouraging. So we are looking at some interesting opportunities in Poland. One thing, however, that has changed about the market since the onset of this second phase of the credit crunch, as it were, is that the cost of funding for commercial property in Poland has increased, by our assessment, by about 1 to 1.25% per annum. And that is yet to feed its way into market figures for the values at which Polish property is transacting. We think it will feed in to the market. The property markets, as I'm sure you all are aware, react quite slowly to changes in other markets, particularly the capital markets. So we would expect that change to take place during the course of 2012. We, of course, are aware that it is going to happen, so when we're looking at properties, we're already factoring in that change, and we won't buy anything unless we're very confident that the income will sustain itself and that the value won't deteriorate during the period of our investment. But the fund market raising remains challenging. Market remains challenging. We more or less invested our UK fund, UK PPP. We are now raising funding for a second UK fund. We have had preliminary discussions with a number of investors, mostly pension funds, though we've also talked to some wealth managers, and we've had very good feedback and interest in the product that we're offering. We're currently in the process of structuring a fund that suits the feedback that we've received, the tax feedback as well as the other sort of feedback we've had on structure that prospective investors like. So we're working on that, and once we've come up with a structure that we feel will meet investor demand, we'll be raising money for that in earnest, as it were, building a book of precise demands. So that covers essentially our fundraising prospects, I think. I've touched a bit on the markets, but going back to the Polish market, Poland as an economy continues to perform extremely well. One of the advantages it has, of course, is that the Polish zloty is floating, so that when the Eurozone goes into difficulties or the global growth slows, the zloty can weaken, and it has weakened by about, fluctuated, but its weakest point in 2012 was about 10%, up from its highs of 2011. That's tremendous for the Polish economy. It's not so brilliant for tenants in our portfolio who pay their rent in euros, because it means their rent bill rises. But we're quite relaxed about the weakness in the zloty, at least up to sort of levels of 430, 440. We're fine with that, because we know that our tenants have principally entered their leases at levels of between 3.9 and 4.1. And more recently 4.2 to 4.3. And since they've entered into these leases, obviously the Polish economy has been growing. So sustaining that level of rental increase is not an issue. And we had a much greater test of the sustainability of our income at weak zloty rates back in 2009, when the zloty moved to 4.95 against the euro, and actually we suffered very little stress, if any, in our portfolio back in '09. So we're pretty relaxed about current lottie levels of weakness. We think that the Polish economy will continue to grow, albeit at a slower rate. We think that the property market will continue to perform well. There are obviously some question marks, as I mentioned, over valuations as a result of the cost of funding for property having gone up, but the fundamental attractions of the Polish commercial property market remain. The UK is slightly different. We have regarded the UK as a sick economy for a long time. We continue to regard it as a sick economy. And therefore the properties that we're targeting in the UK are ones that we believe are recessionary resilient. So we're trying to buy properties where tenants have gone bust in the credit crunch, receivers have been appointed, and receivers have had to re-let the properties at very low rents, ideally to good covenants on long leases, and that's the kind of property that attracts us in the UK. So properties that have effectively had to already take on board and recognise the weakness in the UK economy. And we are able to buy these properties at yields of 7.5% through to 8.5%, which we think is a very attractive rate of return versus the notional risk-free rate of return of gilts down at about 1.5%. As it happens, I've never seen borrowing costs as low as they are in the UK. I think the 5-year swap rate this morning is about 1.2%. If one could borrow at these levels, it would be a fantastic time to be leveraging up to a modest extent to buy these properties at 7.5%, 8%. Of course, the difficulty is in accessing debt, and I think that's got more difficult since the credit crunch entered its second phase in the second half of last year. Page 20 illustrates the kind of properties that we're targeting for our UK fund. We're not looking at prime property. We're quite contrarian in that way. Prime property, which is represented by the dark blue line, is it pretty close to '07 levels of yield, and actually central London is more expensive now in yield terms than it was in '07. So we see that as in bubble territory. Secondary property, which increasingly is being defined as anything outside central London, hasn't recovered in value and by anywhere near the recovery in prime values, and we therefore see our opportunity in what we define as good secondary property. I won't go into details on it again. I've already mentioned the kinds of properties we like, but it's that mauve sort of spheroid shape on the graph. That target is our sort of ideal zone that we're after, properties that fall in that mauve spheroid. So that's the right description of it. It's not quite an ellipse, but so the outlook for the group is a function of our ability to raise funds and the property markets. We are just dealing with the latter first. We are seeing and will continue to see interesting property deals. I have no doubt about that. Whenever there's difficulties in the capital markets, whilst there may be a dearth of capital around, there are always interesting deals to do, and we're working on a number of exciting deals at the moment. Some or all of which may come to fruition. It's unlikely that all of them will, but some of them are likely to do so. And that's very exciting, because actually in these times as a buyer, you can name your terms. So I'm very excited about that. The fundraising market, which is difficult, as I've mentioned, is something that we are grappling with, and I think in the fullness of time we will raise new money for a UK fund, and we will raise new money into Fprop. But of course, if we didn't have a difficult fundraising market, we wouldn't be seeing the opportunities in the property market. One goes with the other. As far as our existing funds under management are concerned, we expect them to continue to perform well. They perform well throughout the credit crunch so far. So we see the earnings coming off our existing properties and our funds as being very secure. We also have, as I mentioned, close on £10 million of cash in our balance sheet. That makes us a very robust company, and there are not many companies that could boast such a large proportion of their market cap coming in cash, and we see that as an aggressive stance to take in these markets. It will allow us to take advantage of opportunities as and when they come our way. The one cloud, I suppose, on the immediate horizon is the euro and what it might do against sterling. At the moment, the euro is weaker than it was for most of last year, and that will, I think it would have a couple of £100,000 effect on our pre-tax profit level if it remains at these sorts of levels. It could go on weakening. But of course, sterling has its own problems, and it is, as an aside, we regard it as remarkable that the international investment community regard, as is evidenced by the UK gilt yield, regard the UK as a kind of safe haven. And if I were George Osborne, I'd be hitting that bid button and raising as much in gilt funding as I possibly could at the moment. But we do see clouds on the UK horizon, so it's not immediately obvious to us that the euro will continue to weaken against sterling. There's every chance that the UK itself might hit a stumbling block and the euro could strengthen from its current position, however counterintuitive that might feel at the moment to most people. I don't intend to go through the rest of the presentation. It sets out some yardsticks on the company's shares, market value, yield, and so on, as well as who the major shareholders are. There's not been much change in most of this information over the last year. So I think at this point I'll open up the call to questions.
Thank you.
Yeah.
We will now begin the question and answer session. If you have a question, please press star, then 1 on your touch-tone phone. If you wish to be removed from the queue, please press the hash key or the pound sign. If you are using a speakerphone, you may need to pick up the handset first before pressing the numbers. John Borgars from Equity Development is online with a question.
Good morning, Ben. Congratulations on another excellent result. One minor question. How is your cash split between sterling and euros? Because I see you raised a bank loan at the same time as having increased your cash to 10 million. So I'm just interested to see why.
Well, we have a policy of, when you say we raised the bank loan, that was against one of the properties bought in Fprop.
Yeah.
And the aim of Fprop is to match its rate of return by leveraging up its capital. So that's just in keeping with that policy. The other policy we have, just to address your first question, is of converting all our earnings into sterling as we earn them. So with the exception, I think, of about 5 million zlotys, which equates to about £1 million, the rest of our cash is all in sterling.
Thank you. So that suggests that you are looking for opportunities to spend it in the UK, which you've already said.
No, we will look for opportunities to spend it anywhere, but given that our reporting currency as well as most of our cost base is in the UK, we think it's sensible to convert cash back into sterling as we make it to avoid any currency risk on hard-earned earnings. And we can easily convert that back into euros or zlotys if we see a property in Poland that we want to buy. But we hold our cash in sterling because that's our home base.
Thank you.
Once again, if you have a question, please press star, then 1 on your touch-tone phone.
Any questions in the room?
There are no further questions from the phone at this time.
Okay, brilliant. Well, should we give that another 15 seconds? And then if there are no further questions, we can draw the conference call to a close. Great. Well, thank you very much, everyone, for attending this this meeting, and look forward to touching base again at the interim stage. Thank you very much. Bye-bye.
Thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.